Good morning and welcome to our Women Wednesday Entrepreneur Series. I'm Brandy Stitt, the Program Director for the Kansas City Women's Business Center. And we've been hosting these sessions every Wednesday on a variety of topics from cash flow management, certification, HR topics, sales and marketing. So we've tried to cover a full gamut of all the content that might be helpful for businesses that have been impacted by the COVID pandemic that we're still currently participating in. So today's session is on Cash is King, the road to informed decision making. Next week, Mary Lou's going to do a follow-on session on operational strategies for profitability. So definitely get registered for that if you haven't already. We are recording these webinars and we'll be posting those on our YouTube channel, the Kansas City Women's Business Center YouTube channel. It takes us about a week to get those posts edited and posted. So we'll let you know once we have those links available, and you're welcome to revisit those webinars. If you want a refresher, feel free to share those with other business owners that you know may be interested. And definitely check out the other webinar recordings from previous sessions that you may have missed. So at this time, I want to go ahead and introduce Mary Lou DeWald. She has been a partner with the Women's Business Center for years and years and years, helping us facilitate a variety of different programs. She is a professor at Ottawa University and also the owner of Goodman and Beauvais. So I'm going to hand it over to Mary Lou, but I am going to be driving her PowerPoint. So I am going to share my screen right now.
So I'll talk on this one just a little bit. Well, good morning, everyone. I'm very excited to see you all, and not see you, but see you, if that makes sense. This is going to be a fairly interactive session. It's one of the ways that I think you can learn best with working with financials is practice by doing. And cash, of course, is one of those topics that people are very either very adept with or very not so adept with, or they think they're adept with it, but they might not actually be as savvy as they need to be. But as we all know, we always say cash is king. Everybody argues for the Women's Business Center. I should say cash is queen, so we could say that too. But the bottom line is you can operate a business for a long, long time highly profitably, but you can't operate a business for a long, long time if you don't have cash. And what many people misconstrue and get mixed up is that cash and profit are not the same thing. So we're going to work through today on looking at your cash, how your cash actually works and flows through a business, and how we can do management techniques and key tools that will, one, hopefully save you a little bit of time, but also help you in your planning in your business. So that's pretty much what the object of the day is. And if you've got any questions, I think Brandy's going to be monitoring the chat, and she will inform us when we've got a question. Don't hesitate to ask questions while we're there. Along the way, and then of course we'll do interactive questioning at the end as well. Okay, let's go into the next slide, please. Brandy. Okay, all right. Number one, what's the difference between profit and cash, and why should you care? I want you to take just a second before we move anywhere, and just in the chat box type a quick answer to that question. Why should you care about your cash?
No responses yet, Mary Lou.
I'm looking at that. I can see that. I'm going to sit here. I'll take a pregnant pause till somebody answers my question. Up there comes one. Thinking. All right. What's the difference between profit and cash? All right, I'm going to give you about a minute more and then I'll break in. Come on, Robert. I saw you put something up. Let's jump in there. Okay. All right. We have our first. Thank you very much. He's saying profit is money that's made and cash is what you can actually spend. I would agree that that is a very good start between the two. But there's a little bit more technical answer to this as well. And the big difference between profit and cash is where you actually find them. Profit is found on the income statement. So profit and loss is the ultimate end result of what you've got on your income statement at the end of the time. And cash actually is reflected on not the income statement, but the balance sheet. And so cash is impacted by everything that you do in the business. So if I make a sale and I ultimately get paid for it, my cash should be increasing. If I purchase something, whether it is an operating expense like rent or rent or utilities or something like that, cash is going to be impacted by going down. On the other hand, I can be spending a lot more cash in buying really big ticket items. Let's say that I buy a new van and I decide to pay cash for it because I need that for my business, but yet that really isn't going to necessarily help me with my profit in the short term. And so what a lot of people misconstrue is that when they are looking at an income statement on the very bottom and they say, ooh, I had a profit of $10,000 last year, they misconstrue that to mean that they actually had $10,000 in cash. And in reality, they may not have that at all. So there are statements that track cash in a business. And one of the statements that we look at, and one of the most important statements that we look at, is what's called a cash flow statement. Okay, Brandy, I need to share my screen.
Okay.
So let's see if it'll let me do this. Okay. Okay, well, why is it not letting me share? So sorry, guys, hang on. I'm hitting share screen. Oh, there it goes. Okay, can everyone see that?
Yes.
All right, so this is I just pulled this out of one of the fast track textbooks that we use on a regular basis to give you an idea. This is known as a cash flow statement. And this is a little company called Clean Corp, and I'm really not caring at all about the numbers. We're not gonna get in and analyze the numbers on this. But the bottom line is what this statement does is it supplements your income statement and your balance sheet, because basically what it is tracking is literal pure cash. And when we say literal pure cash, we mean literally how much cash is in the business at any given point in time in little dollar bills that have presidential pictures on them. And so if we look at this sample statement, at the beginning of this particular company, there was $80,000 in actual cash sitting in a bank. And then over time, over the course of the 4 months, they sold things and collected from accounts receivable. So they had additional cash in, and then they spent, and they spent in a lot of different categories. They spent some on inventory, they spent on marketing, they spent on salaries, and so on down the line. And these were literal cash out expenses. And by that, what I mean is when it's listed on the sheet, it means that in that month, they actually wrote a check or took out of their banking account the dollars that you see on this account. So when we look at this, the cash out in this first month was $217,000. I'm rounding a little bit. And the cash in was $184,000. But when I added that from the previous month, I actually started with $264,000 in cash. But at the end of the month, look at this. I spent more cash than I brought in. In the next month, I also spent more cash. And if you look at this trend, it's not a really good trend that you're seeing in this particular company, because every month they're spending more than they are bringing in. So the way this runs in this summation is I started with 80,000. So here's my beginning cash balance in the first month. Here is my total cash out. That's how much I spent. That was the net. And so the bottom line is my ending cash balance went down from 80 down to 47. And then the next month I spent more than I brought in again. Started with 47, now I'm down to 29. In the third month, again, spent a little less, but I still spent more than I brought in. Net down to the bottom is down to 20,000. And then finally in the last month, I again spending more than I brought in, and I have wiped out not only everything that I have earned over this period of time, but I've also wiped out that $80,000 in cash that I started with. Now, if something serious doesn't happen in the second half of the year for this company, they're going to be in great trouble. And what actually happens in this particular company is that the majority of their income and their business is in the second half of the year. And so they actually end up being okay. But this is not a good trend. And the ideal way that you use a cash flow statement, and the reason that this is particularly important to everyone, is because quite simply the fact that when you are looking at cash, you need to be paying what I call crystal ball, which is always looking forward. You need to be paying attention to what's going to happen in the future, what's coming up. And over time, you get better and better and better at actually predicting the future. And that's what we all want to do, is be able to predict the future. Because if I run out of cash, I am in a very untenable position. It makes it very hard to run the business. I can't go out and borrow money because they're going to sit there and say you're just going to use it up. You're not actually gaining anything by throwing more money into the business. You're just paying more bills. And so this is probably the single most important financial statement that a business should use. This is called, again, the statement of cash flows. All right, cash flow projected. And then what I'm going to run against it is I'm going to run an actual statement beside it. And so my projections become my actuals as time goes on, and I adjust each month, and off we go. So I hope that makes sense to everyone, and I hope that everyone on this call actually is doing something along these lines of tracking their cash proactively into the future through playing the crystal ball piece of the puzzle. And year over year, if you have a cyclical nature to your business, you'll get a feel for my most expensive month from a cash standpoint in expense land is January, and my best cash month from not spending and actually making a lot of money is November, and whatever it is. But you can then see how the money is going to come and go within your business, and at what point in time you need to use that. So I'll stop and ask any questions at this moment in time. No questions? Okay. All right, Brandy, let's move on. Okay, so let's go to the next thing. So beyond having a cash flow statement, there is a third financial statement that is related to income statements and balance sheets. And that is the statement of cash flows. The one we just looked at is typically called a cash flow statement or projected cash flow. And I know those names sound identical, and essentially they are, but they're two different kinds of statements, if that makes sense. One is a formal accounting statement, and that's what we're looking at right here, the formalized third in the trilogy accounting statement of income statement, balance sheet, and statement of cash flows. What we just looked at was what you actually should be running your business off of, which is an informal statement that only the business looks at, and maybe your banker, because actually they kind of get very interested in where your cash is coming and going. But from an operational standpoint, not only should you be tracking the cash day in and day out, but you also should be looking at these three things: operating, investing, and financing cash flows. And I want to talk a little bit about these because they're extremely important in understanding how the money and the cash actually moves through your business. So I can make or bring in money, and I can spend money in three different ways. I can do it through operations. In other words, whatever the business does that it is supposed to do that makes money. And that is known as an operating cash flow. So if I make a sale, that brings me cash into the business. Now, it may have to roll through an account receivable before it gets there, but the bottom line is, in theory, if I make a sale or doing whatever the business is doing, then I should be bringing in cash to the business. I can also do financing activities and bring cash into the business. And the most common financing activity that everybody deals with is going out and getting a loan from the bank. So I go out, borrow money. That is a cash inflow to my business. And the third thing I can do is I can do investing activities. And those also should either bring money in or cost me money. So if I'm selling or issuing stock, if I'm selling or issuing some sort of bond, or if I'm investing in a piece of land for the long term, those are all kinds of investing activities. So when I buy the piece of land, that's going to be a cash out expense. But when I sell that piece of land, if that's something that I wanted to do, then from that investment activity, I'm going to increase the cash in my business. And of course, with bigger companies, selling stock is the most common way that they do investing. Over time, if we look at these three things and how the money is actually coming into the business, this is the one I need to care about, the operating cash flows. Because the bottom line is, if the business is not actually making sufficient cash to keep you solvent by doing whatever the business is doing, eventually you're going to run out of the ability to do investing and financing, and you're going to go out of business. It's just that simple. There are exceptions to this rule, and the one that I always use is Amazon. And I can distinctly remember Jeff Bezos standing on a stage. I'm dating myself a bit here, but he was standing in front of an audience of his investors and shareholders and people in the industry. And he said, "We intend to finally make an operating profit in about 7 years." And everybody cheered, and his stock went up even higher, and we gave the company more money. And well, you know what Amazon looks like today. But that was only because, one, he was able to create something that people trusted would be able to actually make money in the end, which he proved. And the way that he was doing that was he was raising money through investing and raising money through financing for years and years and years. But the operations was taking every bit of that money and sucking it out. Well, that's no longer the case. Now they are a highly profitable, highly well cash flowed company that is making their money from the operating cash flows, and they don't even issue new stock anymore. What's out there is out there. But that's not a small business, and that's not the way we get to operate. And we don't get to stand in front of people and go, well, you know, I'm just going to use all this cash and use up all this money for 7 years, and eventually and finally, I'll be able to make some money through operations. So just keep handing me and sending me your money, and then we'll be good in the end. It just doesn't work that way. Wish it did, but it doesn't. So that is why this is in here, because each one of these activities changes the cash, which on your balance sheet turns around and changes as well. Okay, does that make sense to everybody if you look at how these flows on this go? All right, so let's move on. Brandy, next slide, please. So when you're looking at cash flow projections and how much cash you can actually have, you can look at it in 3 different ways. The most simple, when you're starting out and what you're caring about, the most simple way to look at what the cash in your business is going to be is to take that profit, but you can only do this if you are a true cash business. You add back anything you have for depreciation, because that is a non-cash expense. And again, what we mean by that is when you depreciate something, you're not actually having to write a check for it and spend money on it. You're actually, what you're doing at that point in time is you are just allocating the costs that you've already incurred for that item. So for example, the van that we talked about earlier, I can depreciate it over 5 to 7 years, and I get a little bit of a savings from a tax standpoint, but from a cash standpoint, it's not doing anything for me at all. If I look at a little more complex way to look at my cash flow, then I take what we just talked about, all my beginning cash minus its sources and uses. So was it from operating expense activities? Was it from financing activities? Was it from investing activities? And then the intermediate, of course, is somewhere that's kind of in between. And this is what most small business owners do. They're somewhere in the middle here, where they're looking at net profit and depreciation. Then they're adding and subtracting the things that they deal with the most, which are accounts receivable, inventory, and accounts payable. And then they ultimately end up with what their actual cash should be. And all that then translates back onto that cash flow statement page that we showed you at the very beginning. So from this introduction standpoint, what I want you to understand is that cash rolls through things in two ways. One, we look at it from the pure cash in, pure cash out standpoint of how is the cash moving through the business. That is your management sheet that you use on a day-to-day basis. And then we look at it also from where is the cash being generated. And that is more an accounting concept, but it's also just as important for you as far as making informed decisions, because you've got to understand and know, am I making it from the operations side of the house, or am I making my cash and bringing it in from other sides of the house? Because that's not sustainable for the average small business. So two different ways to look at cash flow. Both are important. One is more day-to-day. One is more bigger picture for long-term and planning. Okay. All right. Next slide. So we have a cash flow statement here that is the intermediate way of looking at things. And this is blue sky. And so what I want you to do is take just a minute and look at this cash flow statement very quickly. And I want you to decide whether the company is actually making money from operations, from financing, or from investing activities. All right. So here we have net profit. And then we have all of these adjustments over this period of time. So they had an increase in petty cash, which meant they spent cash, if that makes sense. They bought some equipment, so that reduced cash. They bought more inventory, that also reduced cash. They had an increase in accounts receivable, which means they allowed more people to walk into their business and say the magic words, charge it. They also paid themselves. That's what an owner's draw is, a nice healthy chunk of money. Then they actually were able to gain some cash through accounts payable. And in accounts payable, what they did was they didn't pay some of their bills, and so that saved them $200. They'll have to pay it eventually. They borrowed money. There's a note for $12,300. And then, of course, they have depreciation, and we kind of ignore that one. So my question to you is, this is the operating activities over the course of the month. How is this business doing? Are they actually making money doing what they need to do? What do you think? Again, just type something in chat and let's see what it looks like. Yes, I agree. They are losing money. That is exactly right. So the issue here again, and the fact is that what is actually happening here is they went out and they increased a note payable. They do have some profit, but the bottom line is that they sucked all of their profit out in their owner's draw, if everybody sees that. They did buy a little bit of equipment, but the $3,500 in equipment that they bought, they are doing on a $12,300 note. So if we get into something called matching, which if you think of matching my borrowing to the kind of asset that I am doing, I borrowed a whole lot more money than the $3,500 piece of equipment should recognize that I have borrowed. And so the bottom line here is, if this company keeps doing stuff like this, they are not making the kinds of money that they need through operations, and it's not going to be sustainable. I hope that makes sense to everyone. This is kind of hard on a webinar like this to work through, and I can't look into your eyes and make sure that you're all getting what I'm trying to say, but this is what you really kind of need to look at a bit more, is this bigger picture, and not just the cash flow statement that has everything month in and month out, but also what are you doing long term, and how is that impacting your cash? And the bigger question is it sustainable? That's the thing that everybody needs to care about. So that's my intro to cash flow. Now we're going to move on into other areas, and we're going to look at a couple other tools that we use when we're playing with cash in order to make good informed decisions. So once I kind of have a feel of how the cash is coming and going in my business, then the next thing I also need to know is, how does it actually flow through the business? From the time that I lock up my dollar in my business until the time that it goes through a whole cycle and it's free again for me to then make another decision of what I'm going to do with that money. And that's known as the cash conversion cycle. Okay, next slide, please. All right, another complicated slide, but this is This is very important that you understand this. Think of this as a giant long tube or straw, or a big long straight piece of pasta if you want. And I like the pasta analogy because you can shrink a piece of pasta, you can kind of stretch a piece of pasta out. And depending on where you are in the whole scheme of things, it gets longer or shorter. So think of it this way. If we look on the left-hand side and we place an order, or someone places an order with us, then we have to turn around. We're going to be a manufacturing firm for this example. We have to turn around then and place an order for our raw material in order to make this a realistic scenario. And what I want you to do is look across the top. So from the time the order is placed all the way to the right-hand side, when we finally get placed for our order, that is actually how long my money is tied up. So it's a decision-making process. Now, the real true cash doesn't actually get tied up until that delivery invoice comes in. So usually there's a little bit of a lag between the order placed and the delivery invoice. But if you are cash on sale, then your operating cycle and your cash cycle very well could be just as long as this entire stream that we are looking at this point in time. So once I have decided that I'm going to manufacture something, in this case, I place my order for my raw material. I'm back up on the black light again. I get the delivery invoice because the raw material arrives. Then I have to produce. That's the next little section in there. So this is when I am producing and creating the item. And there's a certain number of days for any given business that actually takes. And then I actually execute the sale and deliver the invoice to the person who is buying my product, good, or service. Everybody understand that? So I have tied up cash before I ever make the sale. And that's what a lot of people miss. They tend to look at their cash conversion cycle just as the moment from the sale all the way to when they get paid. But it's actually much more than that. This, of course, is a manufacturing firm where I have to order material and I've locked money up and then I have to produce. But if I'm a retail operation, I still have this back side of the house, if you want to think about that, because I had to order something from someone else to have it in stock in my store. Same thing. We may not call it production, but you've got it in there. You've got it in inventory. You've got it sitting on the shelf somewhere for a given period of time. And who knows, it may have been sitting on the shelf for a very long time before it's actually sold. Now, a company that is extremely good at this is Walmart. And in Walmart's example, their days in inventory, which is not production for them either, is very, very short. If something is sitting on a shelf longer than roughly 20 days, they tend to drop that item from their store because they consider that too long a tie-up of their money in that item before they get a chance to actually come out and remake money off of that item again. So they are very ruthless on this front end piece of the puzzle on when they have to pay. They also actually tie that back to, if you look at the blue line down below, the average days in accounts payable, their blue line would go all the way basically until the end, because they are not going to pay their vendor or their supplier until they actually have the money from that item. And that is why their cash conversion cycle is practically negative, because they're actually getting the money from the sale before they ever actually have to pay for that item in the first place. So if you're a small business owner working with Walmart, you are told up front that your terms are going to be somewhere from 150 to 180 days. Yes, that's 6 months. And what that means is essentially you are banking Walmart for having your product on their shelf. So you have to take that in consideration, because you are going to have your money on that front side of your cycle tied up for a very, very, very long period of time. And I know that doesn't sound fair, and people always are like, I don't get it. Why on earth would anybody do that? It's because they are very good at what they do, and they are big enough to leverage all of us into doing what they want us to do as far as cash conversion is expected. All right, I'm back into the middle of the slide again. Now we have our sales. I'm on the top line. Sales is delivered. We make our sale. And then the people walk in the door and they say the magic words. And the magic words are, please charge it. And what I mean by that is not charge it to a credit card. That's considered a cash payment because you get it essentially in your bank within 1 to 2 days. but this is an actual where your company is carrying an account receivable. There's the blue line that runs across, and then you see expected payment date. So this is where your term is, your 210 net 30 or your 115 or whatever it is. But most people don't pay on time, or a large portion, particularly during COVID, are not paying on time. And so even though I expect to receive payment in 30 days, I may not be receiving payment for 45 days. And so there is the actual payment. So you've got an operating cycle that runs all the way across, and then you've got a cash conversion cycle. And that cash conversion cycle is how long that money is actually tied up in this process. So if I'm looking at the little blue underline of the large picture that says cash conversion cycle, it's from the day that I actually kick my money into the cycle, which means I am paying my account payable for all of this until I actually get my money back out. And so if I have put $5 into this cycle, then what that means is I can't spend that $5 on anything else because it's tied up in this sales process. But when I get the $5 back out, not only should I be getting the $5 that I tied up in this process, I should also be getting more, because I should be selling my items for more than it's actually costing me. And that amount that's being kicked off is a combination of profit and operating expense overhead that you have to turn around and plow back into the business. But at that point in time, then I have to decide what I'm going to do with the money that I just received. Do I turn around and plow it back into this and make more money? Or do I turn around and take it out of the business? I hope you answer, you're turning around and plowing it back into the business to make more money. So this is your cycle, and this is by far one of the single most important cash tools that your business needs to have in order to successfully undertake cash management. You need to know what your cash conversion cycle is. And so if my cash conversion cycle is 30, then over the course of the year, I am 30 days, then I have 12 chances to make a profit, and only 12 off of that particular dollar that I am putting into this. So if I am something like a gift store, I may only get 4 chances a year to make a profit. And so my cash conversion cycle, because I order in gifts and they sit for a very long time on my shelf before someone buys them, because that's the nature of my business. When the money spins out on the top side, on the backhand side, I absolutely need to make sure that I know and understand that there is plenty of profit in that spin-off so that I can have enough profit to actually survive over the course of the year. So if you do not know what your cash conversion cycle is, that's one of the first things you need to do and learn. Okay, Brandy, let's go to the next slide. So here's formulas. And again, there's lots of different ways to calculate these formulas for the most part, but the important part again is that you understand what the components are and what they're actually measuring. So we're looking at our inventory, how long that inventory is trapped in there. We're looking at our receivables and how long our money is trapped in a receivable. And then we get a little credit for our payable days, the amount of money that we were letting one of our vendors actually carry the cost and expense for us. So it's inventory outstanding plus receivables outstanding minus days payable outstanding. And that is what you use to actually calculate your cash conversion cycle. I hope that makes sense. I wish we could actually do an example here today, but unfortunately, that's not the ability that we have on this. But I want to put this into your thinking hat so that you go, oh, I actually need to be looking at working on one of these. All right. Before we move on, any questions on the cash conversion cycle? So we talked about cash flow, and we've talked about those two statements, the cash flow statements. And now we talked about this item called the cash conversion cycle, which is another way of looking at cash. And hopefully you see how those tend to tie together a bit. So let's move on. Okay, they're gonna zoom in. Okay, stop right there. Oops, go back one. She's giving you the answer. All right, so I want you to take just a couple seconds. Hopefully nobody read that fast. And I want you to tell me what Wonder Company's cash conversion cycle actually is. And you can just put the answer in chat. So I've done the calculations for you, but what is their actual cash conversion cycle? Okay, Brandy, let's go ahead and let that fly in there. All right, so how do we calculate this? Again, so we have our accounts receivable days. So 47. So the question then becomes, do you think it really is 47? Would anybody have terms of 47 days? It may be 30 days and people are actually paying at 47. So what that would quickly tell me or quickly question or have me question or make me question is if I am actually actively working on my accounts receivable sufficiently to get people to pay based on the terms that I have. So if my terms were 45 days and my actual is 47, I would say that's pretty good. But if my terms were 30 days and my actual is 47, all of a sudden I'm 50% off, if that makes sense to you. In other words, people are just basically blowing me off for 2 more weeks before they ever get around to paying me. And instead, what that makes me do is play banker for them, because I am carrying my business is carrying their money. I'm playing banker. So I have already allowed them to have my product, good, or service. And now I am allowing them to use that essentially for free. And then they're finally getting around. And that slows down my accounts payable, receivable days. And it also slows down my cash conversion cycle. And as we talked about previously, the most important thing in this, again, is that I have a shorter, tighter, tinier cycle, because that gives me more chances to make a profit. And the only way I can make a profit in a business is by running money through the cash conversion cycle more times over the course of the year. So 47 may be problematic. Then I look at my inventory days. And in this case, my inventory days are 35. And again, I don't know whether that's necessarily good or bad unless I look at something like my historical days in inventory. From the time I buy something to the time it's finally sold, how long is it sitting there? And 35 may be very good. If I'm something like a steel plant, I just happen to know that because their days in inventory is around 120. So 35 would be fabulous for them. It means they're actually doing something really well. On the other hand, if I'm a grocery store and I've got a can of green beans sitting on my shelf for 35 days, I may very well be in trouble because 1, the can is aging out, but 2, it is not a product that I actually should be carrying in that brand, because they should be turning every 1 to 2 days. And how do I know that? I know that because I can look and see what industry averages are in my industry and know that that's typically how often a can of green beans turns over on the shelf. So again, those are my 2 additions. From that, I do my subtraction of how long I used other people's money, in other words, my vendors and suppliers, and how long I used their money in order to offset some of this days. And if my terms were 30 days and I'm paying in 33, well, I'm basically paying on time. But if my term, again, was 15 days, I'm dragging 2 weeks, just like people were dragging us for 2 weeks. But as long as someone else is not yelling at me and not charging me a penalty for doing that, I should stretch that as far as I can. On the other hand, if my payable days is 45, then I am not taking advantage of a cash management tool that I have at my hands, which is to let them carry the cash for another 12 days to make 45 days. So again, it all depends. All of these numbers are kind of an it depends, but these are the 3 numbers that I manage and look at, and it's a very quick down and dirty number that I can calculate very quickly and very easily to get a feel for whether I am actually managing and using my cash to the best of the ability. And so my final is 49 days. So if we have a cash conversion cycle of basically 49, 50 days, how many cash conversions can I do over the course of a year? Well, you divide 365 by 49, and it's somewhere right around, what, 6, 7? Roughly 7. And so I only get in this company, based on the way that it is currently set up at this point in time, I only get 7 chances to make money. So that's not a particularly successful successful business, if that makes sense, in the fact that you know, I have to make a lot of money off of each one of those in order to make each cash conversion worth my while. So again, 3 components go into this. 2 of them are bad, if that makes sense, because they are tie-ups of our money. 1 is good. The account payable I consider good because that's using someone else's money. But then when that all ties together, then you find out how many chances you get a year to make a profit, and that's it. And so that is a number that everybody needs to know at all times if they are in business for themselves. They always need to know exactly how many days and how many chances a year do I have with the cash that I have available to put into this business to make money. All right. Okay. Enough on cash conversion. So next thing we need to use is looking a little bit at, there's lots of metrics. Everybody wants to give us some metrics, something that we can pay attention to and actually have a good feel about what our cash is. But I want to talk about basically 2 kinds, what is relevant and what is not relevant. Okay. So next slide, please. So this is a very different way to look at cash than a lot of people tend to look at. But it's looking again at impacts on cash and impacts on cash flow from 2 different pieces, from your financial metrics. In other words, the numbers that you are gathering about your business compared to the customer. Because again, one thing that I have not said that everybody that knows me knows I say 8 million times, and it is one of my 3 mantras, and that is no customer, no business. So I don't care how wonderful your product, good, or service is, if you do not have a customer for that product, good, or service, then the bottom line is you absolutely are going to be out of business, because if no one's buying your product and they don't care about it, so be it. The other piece of the puzzle then, actually with the customer metrics then, is not only is it no customer, no business, but what about the customer that actually impacts the different pieces and parts of the financial metrics. And I find this to be one of the cleanest and simplest and best examples of the metrics and how they play out and which ones actually have an impact relative to cash flow. And when you get through with all of this and we look across as our financial metrics, you've got sales growth, you've got gross margin, you've got operating cash flow, you've got market share, and you've got shareholder return. Yeah. And I don't know what, just my stuff just did something strange. Hold on just a second. I've got to make, and I can't get that to go away. How weird. I don't know why it's do. Hang on just a second. I'm having another crisis with my computer. Who knows why? Okay. I can't get that to go away. So now I'm looking at a tiny screen. The bottom line, though, is the one that's important, the one that is the single most important for everyone to care about and to pay attention to, is customer satisfaction. Because of all of those customer metrics, that's the one that ties back into whether people buy, whether people actually come back and buy again, and whether people are actually really interested in using your product, good, or service in the future. And so customer satisfaction is the one that I would recommend that everybody start paying attention to, because what it does is directly impacts your operating cash flow. Now, some of the others have, have some impact, but that overall satisfaction is the one that impacts your cash flow the most. So if you haven't been looking at how the customer is impacting that cash flow from these non-tangible things, complaints, repurchase, satisfaction, word of mouth, you need to start kind of looking at that because a lot of people spend a lot of time on customer satisfaction because they know that the bottom line is that is actually what is going to impact the success of your business, creating operating cash flow the most. Any questions on that? So again, just another little piece that people often tend to not think about, but you probably should be thinking about because it is the single most important factor on that cash flow actually moving the way it should. Okay, next slide. Okay, so let's look at the importance of cash. Go ahead. All right. Like I said at the very beginning, cash flow is probably one of the most misunderstood. People, again, just kind of equate it to whatever the profit is at the bottom of the balance sheet, which is funny because they don't equate it to the loss. They only equate it to the profit. But there are a lot of things that about cash that are very, very important. And here's the biggest, and I said this again at the start of the presentation, but cash is considered an asset. It is an asset. It is on the balance sheet. It is the first asset listed on the balance sheet. And it is primarily changed by other assets as much as it is anything else. So when you buy something, that changes your cash. When you issue account receivable credit to someone, that impacts your cash. When you pay something or buy something and it's a liability, that impacts your cash. And if you take money out in the form of retained earnings, you take an owner's draw or you pull money out of the company, that impacts cash. And what I typically see is people think of cash as an income item, something on the income statement, and it's not. It is an asset, and it has value, and it shows up and is reflected in your net worth in the business. And so you need to wrap your head around the fact that you are playing with an asset when you are playing with cash. You're not playing with profit when you are playing with cash. The second one, it comes mostly from business income, including accounts receivable, collections on accounts, and increase in cash. That's how it comes into the business for the most part, unless you're doing financing and investing activities. From operations, it comes from the business doing whatever the business does. And we talked about that at length, but I just want to remind you again that you need to wrap your head again around the fact that it is operating activities that maintain a viable company's cash position. The third, it can be increased by increasing liabilities such as borrowing. That's the financing activities again. But that also has a downside because it's also going to be decreased by more than you borrow because you have to pay back the loan at some point in time along with that cute little interest payment that comes along. And then it can be increased over time by increasing retained earnings. So in other words, if I go out and I sell stock, that increases the value in my company, or I also can contribute more money to my company, more pure cash to my company by doing an investment myself as an individual. But those last two, again, are the ones that are financing and investing activities and not the operations activity. And again, the key issue here is that you want to make sure that you are paying attention to the way that the cash actually floats about the business and where it's actually coming from at any given point in time. Okay, next slide. All right, what are the costs? So cash has two kinds of costs. Well, actually it has three. One of them over on the left on the blue is this thing called an opportunity cost. And so every time you do a financial transaction, you have what's known as an opportunity cost, or I call the either or cost, and that's just my own personal terminology. So think of your own personal scenario here. My mother gives me $100 for my birthday. All right, I can do all kinds of things with that. I can spend it, or I can put it in a savings account, or I can put it in stocks and bonds or whatever. Well, the opportunity cost is what is lost by not picking one of the other options. So if I know for a fact that I could put my $100 in a stock and I would get a 5% return this year, And I know that I could put that $100 in my savings account and get a 2% return. The opportunity cost for putting it in the savings account, which is safer, is 3%. It's the difference between the 5 and the 2. Well, in business, in the real world, you are doing the same thing all the time. Every time you are taking that money that's come out of your cash conversion cycle and you have profit sitting there with an increase in cash in your business, there is a trade-off when you decide what to do with the money. And so one of the things that you've got to figure out is what is what I call highest and best use. What is the highest and best use of the cash each and every time you have an opportunity to actually do something with the cash in your business? And one of the things that you need to work on is coming up with what are those opportunity costs? How much is it actually costing you to have that cash in the business? And are you better off putting it in investment A versus investment B? My best example of this is the one, again, when we get into this bottom one in the darker green called implicit. But again, do I really want to invest in something that's only going to give me a very small return occasionally? Is that necessarily what it would be the best and highest and best use of my money at that point in time? Or am I better off putting it into, if nothing else, just putting it into a savings or a CD or a short-term money market, and then having the opportunity for it to be earning all along? Go back to the Walmart example. Walmart pays attention to opportunity costs in absolutely every single thing that they do. And what they are looking at when they're making their decisions is, am I going to use my money or am I going to use someone else's money in order to actually make this a profitable business? So tied in with that are two kinds of costs. One are explicit costs or direct costs, such as your wages and your labor and those things. With those, you have less of an opportunity cost because they are what they are, and they're costs that you have to have. But again, what you want to look at from the opportunity cost standpoint is, do I really need to spend that money? Am I just spending it because I think I need to spend it, or do I really need to spend it? Is there something else, again, that I could be doing? So I'm not telling you to spend huge amounts of time on this, because I see people get hung up on this a little bit too much. But if you have a choice of good, better, or best, maybe better is okay. And that $20 a month you're going to save doesn't sound like a lot, but over the course of the year, that's $250. Again, slight rounding there, but I think you get the idea. Then I have $250 that maybe I can invest in something else that actually is going to speed up or tighten that cash conversion cycle and make the whole process more profitable for me. Now, implicit costs on the other hand are the costs of sitting on things you already have. And I call this also a lost opportunity cost. And so with cash, again, it means you've tied up cash and stuff that's not exactly making a lot of money for you in an extended period of time. And so the example that I'm giving you here is the backhoe. Well, if I am a contractor and I use a backhoe a lot, that's wonderful, but only if I use it all the time. On the other hand, if I buy that $20,000 or $30,000 backhoe, I'm buying a very used backhoe, and I only use it twice a year, why on earth have I tied up $30,000 into that item when I could take that 30 and probably reallocate it to other things over an extended period of time? And what you see in businesses that have been around for a while, and even in new businesses starting out, is that they've got a lot of implicit costs that are tied up in things that are absolutely not contributing cash-wise or financially in any way to the business. And they are exactly what they are, a cost. Because once you have something, once I have that backhoe, there are other costs associated with it. I have to care and feed the backhoe, if that makes sense. I have to house the backhoe. I have to insure the backhoe. There's all kinds of things I've got to do with that that are ongoing explicit costs that are tied to the fact that I have this implicit cost. So again, opportunity, what is the highest and best use of my money? So again, a piece of the cash puzzle that it takes 2 seconds to start really paying attention to this and starting to look at where that money and that choice is being tied up so that you can get a little bit better use of your money out of your business all the time. So think of your opportunity costs and learn what that dollar figure is. And then you'll know and be able to make those financial trade-off decisions easier because you'll know what's going to actually end up being the very best option for you. All right. So one more piece of the puzzle in the arsenal. Yep. No, I'm finished. Come on. All right. Probably the single most important thing we're going to do today is this next piece of the presentation, and that is calculating the literal cash cost of increasing the sales in your business. So again, back to basic fundamental processes. It's a concept called permanent working capital. If you want to think of it this way, in order to add $1 in sales, it's going to cost me money that goes into the business, and that money or that cash is stuck in the business until I liquidate the business. So it's not lost. It is one of the implicit costs because it goes in there, but it's stuck in there. And it allows me to do more business, but it's permanently in there and I can't get it out. And that's the key that you need to understand. So one of the things that we see in small business consulting all the time is an individual grows and grows and grows, and they grow themselves into bankruptcy because what growth eats is cash. In other words, I've got to feed the business this cash to be able to support the underlying additional business that I have. And so one of the things that most small business owners do not know, and as I said, this is probably the single most important thing we're going to talk about today, is what is the cost of an additional $1 in sales growth to my company. Okay, let's go to the next one. All right, so everybody needs to get out a pencil and paper. I'll give you a second to pull that up. This is a company called Megabucks. And Megabucks had sales of $240,000 last year. So this year's sales are projected to increase by 25%. So what will sales be this year? All right, last time I checked, it's going to be $300,000. I'm putting these answers in chat. Everybody agree? All right, then they've given us a tidbit of information. Their depreciation is $5,000 a year. That's a lovely little piece of information. Does it impact cash that much? The answer should be no. All right, the net profit is projected to be 5% of sales. All right, so if I have 300,000 in sales, right? That's my next calculation. How much is that in dollars? Okay, and then the next question that I've got in there, so how much is this in increase in total? So I started with I have 300 compared to last year's 240. And that is an increase in sales of $60,000. All right, so let's go back and look at that. So basically I know from the last half of the year or the last years, that this is what I can honestly expect my increase in sales to be over the course of the year, because I know that I've got additional projects coming up, or I've signed additional contracts. And so the bottom line is my little company is going to grow $60,000 in sales. So the question then becomes, what does that really actually cost me in cash? So we're going to use some of the tools that we've already come up with, looking at our accounts receivable and our inventory turn, and our accounts payable, which is our cash conversion cycle, to see how much cash we've got to kick in for every $1 in sales in order to actually make this work. So moving on, accounts receivable turnover is 45 days. So how would I calculate that? Well, I would take 365 days divided by 45 days. And that is going to give me how many turns a year? 8. Everybody agree with 8? So how much is that going to give me in actual accounts receivable then? 60,000 divided by 8 is 7,500. Okay. Next question. Inventory turn, 6 times per year, requiring an increase in inventory of, so I'll do the same thing, 60,000 divided by 6, and that gives me an increase of 10,000. Everybody agree with that one? All right. Besides increases in receivables and inventory, more sales mean the company needs bigger operating cash balances to cover operating transactions. For megabucks, this amounts to 5 cents to support $1 in additional revenue. So I have 60,000 times 0.05, and that is going to equal $3,000. All right. Next one, Megabucks uses trade credit for its inventory purchases, and the terms are net 30. This provides a cash savings to the company of how much? So again, this is the third in our cash conversion cycle piece of the puzzle. So we have 60,000. The assumption is here that everything is sold on credit, or everything is paid. We said it was 30-day term, right? So that would be how many turns a year? That would be 12. And that's going to give me 5,000. All right. So those are all of the answers down the side. So what does this really mean? Look at the right-hand side. An increase in revenue of $60,000 requires an increase in cash of, and we're going to go back and add through these, 7,500 in accounts receivable, plus $10,000 in inventory, plus $3,000 just in general operating expenses, minus my $5,000 for inventory purchases. Again, see what we are doing? We are using, and we have just created a cash flow cycle. And that gives me a net of $15,500. So every time a sale increases by $1, the business will need an additional 26 cents in cash that's going to permanently go into the business. So again, how did I get that? 60,000 in cash divided by my 15,500 that we just did, and that gives me, that's not right, 0.26 cents. So think about that for a second. I really will never have $1 increase in revenue. I have to have in presidential picture little dollar bills sitting at any given point in time. Every time I increase a sale $1, it's costing me 26 cents in pure, unadulterated, old-fashioned, what everybody knows and loves and understands, cash. And that is the single most important number that you need to know and understand in your business. So that if somebody comes up to you and says, I've got a $500,000 opportunity for you, can you handle this? The answer is, I may or may not, if I have the cash ability to do this. So sometimes when you get an opportunity to sell, the most important thing you can do is to say no, because it will put you out of business to accept the sale, because you literally do not have the cash, nor do you have the ability to generate the cash in order to undertake the growth. And so I keep saying it, but if there's one thing you take away today, I wish and I hope that this is what you will take away from the business today. This is by far the single most important thing that we talk about. All right, let's move on. I'm going to run out of time. Okay, so let's see how we divide and conquer costs in a way that will bring maximum impact to the bottom line. Okay, Brandy, next. All right, go ahead and just put all of this one up very quick. Thank you. Okay, there you go. Oops. Okay. So another tool, this one's break even. Everybody is familiar with break even. Everybody loves break even. Everybody knows everything about break even, or so they say. But there is a way to use break even that technically isn't break even, if you get right down to it, that allows you to figure out how much you've got to have in order to actually make a certain level of profit. And so what we're doing is we're kind of hybridizing the break-even model here by adding, if you look in the upper left-hand corner of the first piece of the puzzle, we actually add profit to the top line. So technically it's no longer where is my business breaking even so that I'm not making money or not losing money, but now I have arbitrarily baked in a certain level of profit into my calculations so I can figure out very quickly what I actually need. So the pencil factory is my example here, and they have or want $10,000 in profit this year. So they have $50,000 in fixed costs. And for each gross, which is 144 pencils, their variable cost, or their cost to produce that, is $14, and they sell each one for $20. So if we plug all of that into the formula, here's my 50,000 in fixed plus my 10 that I want in profit, and there's my $20 that I sell for minus my variable cost of 14 or 6. At 10,000 gross, basically I am going to make a profit of $10,000. Now it just happens to come out that it's 10,000 and 10,000. I need to change this example so that it doesn't happen. But the bottom line is this: I can then, instead of trying to calculate, oh, what's my break even, as I am an established business and moving forward, I can set my production goals and projections to actually mean that I am at a certain level of profit for the year and work towards that rather than just trying to work towards break even. So again, it's using that cash and that costing piece of the puzzle to actually make this be something that you can use on a day-to-day basis. The next question that you need to always ask is, what does that really mean for the company? What does manufacturing 10,000 gross mean to the company? So in other words, how much are they making, how many gross are they making per month? So if I divided 10,000 by 12, it's what, about 830 or so a month gross of pencils. That sounds doable, but it may or may not be, depending on the size of the company. So you always need to check against reality in that, can your production actually do what it is that you're saying? Even those of you in service businesses, your limiting factor is time. So if it takes you, 9 hours to do a job, no matter what, there's only X number of 9 hours over the course of a month that you can actually bill out as actual production. Otherwise, you're just not going to be able to have the time to do that. Okay, let's move on. All right, so let's kind of tie up a lot of what we've looked at up to this point in time on how I can also improve my cash flow just by doing tiny things to a lot of the different things that we've paid attention to. So if I reduce my cost of goods sold cost in this example, we have an example of $100,000 with a company with 100,000 turnover. If I reduce my cost of goods by 1%, and I reduce my overhead by 6%, and again, that's looking at all those different kinds of costs, I tighten up my accounts receivable, I tighten up my inventory, and I do a 2% price increase, there's a very quick improvement of $10,000 in cash flow. So for your company, these are the typical things that people tend to do in order to actually generate and increase cash very quickly. So again, it's looking at reductions in cost of goods, reductions in cost of your operating costs. And then again, we're back to the thing that I keep harping on, that cash conversion cycle, playing with the pieces of the puzzle that's that. And then of course, everybody always wants to throw in a price increase, but here's a very quick and easy example of how 10,000 can be squeezed out of a company without a lot of tweaking or changing. These are subtle changes for the most part. So again, how do you actually start putting this into action? That's one way that you can look at this and do it. Okay, let's go. Brandy, please. Okay, let's look at a way to improve profitability and financial performance. Okay, stop right there. Okay. Oh, okay. Well, that is all of it. All right. So another thing that people tend to not pay attention to is What are the things that are really actually playing into the fact that you are making money and making profit? And again, we're back to that no customer, no business piece of the puzzle, but it is this. It's all around, again, that soft side of the house of customers and what they do and how they do it, and that customer satisfaction. And again, ties back into what we talked about earlier with the whole issue of cash flow and how the cash flow is impacted by whether the customer is satisfied or not. So this is a formula that most people don't figure out what the components actually are. Most people can get that the C is the customer, and most people after a while will finally get that the P is price, but the F and the T are the ones that confuse people very, very much. But this is exactly what you need to be looking at. These are the 4 factors that actually impact what your revenue is. So it's the number of customers times the frequency of purchase times the average size times the price. So keep in mind again that it's not just selling the product. When we're looking at cash flow, it also is back to these metrics and how these metrics actually tie in again in a whole cohesive way to get the customer to do something that you want them to do, and to get them to do it consistently and over and over. And how many chances do you have to make $1 on that particular customer? And it all again ties back to that's the way the cash flow actually comes out of the company in a much higher and much better way. So questions on that? Again, just another tool of what you should be paying attention to. All right, let's move on. So as I put in the little thing, now maybe you can see, why people fight for a penny, because pennies add up and pennies make a lot of difference. And so again, I like this example because it just shows how much goes into actually making a company profitable. And of course, you can't be profitable long-term unless you've got the underlying cash and the pieces in place to actually make the cash flow do what you need the cash to do. And so one of the biggest things again is that you need to look at how all of these pieces and puzzles tie together. And what I like about this slide again is it's got client expectations up there. Because again, I think when people are looking at cash flow, they divide it out because they think they're looking only at the financial side of the house and at what financials are doing and what's going on with the financial piece of the world in the dollars and cents, like the literal actual calculations that you're using. But in reality, it's a combination of using these key tools to be able to calculate, know what your cash is, know what the cost of the cash is, and then also tying that back to the customer and the customer satisfaction piece. And so cash and cash flow and the customer all tie together to actually make the profitability of the company actually be what it needs to be. All right, let's go to the very last slide. So, summary here, financial rules. We've gone through a lot of stuff today. I've run my mouth for a very long time, but what I want you to take away from this is that you can pick 2 or 3 or 4 tools for your cash management piece of the puzzle, and it only takes you about an hour a week to do this effectively. And that's all you really need to be worrying about. And if you've got these key numbers, these key metrics around your cash, such as your cost of cash that we calculated with megabucks, such as your break even with profit, so that you've got your metric for production and where you need to stand for production for a certain level of profitability in the end, cash increase in the end. If you've got your basic cash flow statements set up so you can play crystal ball, then the bottom line is you can focus on making the experience more efficient and more effective with the cash conversion cycle, which is kind of the granddaddy of them all, because it keeps tying again back into your other figures and finances in a very detailed way. And the bottom line is, and in that way, you can determine whether there is a need for borrowing or a need for additional cash injection, or the need to not accept a job at some point down the line before that actually becomes a reality, and before you're actually before you're actually in trouble, because you've either grown too fast, or you've invested your money poorly and you haven't looked at the opportunity costs, or you are just flat out not realizing how the cash is flowing through the company and you've got a lot of dead ends and stops along the way. All right. So hopefully after today, you'll look at cash in a little more optimistic way and understand that there are lots of options and lots of ways for you to actually take cash and use it to your advantage, and make it a tool that is actually working for your company rather than something you're panicking about and stressing about all the time, that you know and understand it at any given point in time. All right, so Brandy, we can stop screen sharing, please. And go back to questions or answers or chats or whatever you'd like to do.
Yeah, feel free to pop in any questions into the chat box. And we'll give you just a minute or two.
So Bob, I'm reading your question. Which example do you want for a service business? For which specific one? Don't say all, because it'll be too hard to. So let me just give you some kind of general things. People think that service businesses are dramatically different when it's looking at cash from, say, a manufacturing or a retail operation, and they're really not. It's just that you're going to have different nomenclature and different verbiage on how you're wrapping your head around each one of the different pieces of components. You don't have inventory. That is absolutely true. Compared to what a manufacturing firm would have. But you do have upfront costs that you have to pull together. If you are hiring someone else to be a subcontractor, I almost consider those individuals something like inventory as well, because it's a cost that you've got to actually tie up on the backside at some point in time. So if you want, Brandy will be happy to share my information with you, and I can actually walk through some specific examples, and it'll be easier and better for me probably if I actually have a little bit more detail about your business specifically, so that we can walk through how you've got stuff set up, and I can give you examples that would match that. But the general overarching things don't change that much. It's just the verbiage that's changing. And unlike accounting, where it's very black and white and everything has to be exactly perfect, when you're doing cash flow and some of the examples that I gave you here today, you kind of tweak them to make them match exactly what you're needing your business to figure out. So there's the basic formula, but then we kind of play with it to actually give you the data that you're actually looking for on the backside. Does that help at all? I know I'm not giving you a specific example, but we went through a lot today. So your web development. Okay, so your cost of product, the way I kind of look at cost of product in a particular business like yours is, again, it's going to be that contract labor, if you've got that, as much as anything else. So your labor is your cost of goods, whether that is someone that you have on staff full time, or whether it's someone you're hiring from a contract perspective. That is your cost of your product, is the investment in that labor for the most part. So, and that's not true accounting. So keep in mind, what I'm saying is not correct accounting, but that's not what we're after here. We're after coming up with these costs, your cost of a sale, your cost of other things. This is more what we're looking at from an internal standpoint and not true accounting. So.
Yeah, and I'll make sure I get your contact information shared as well.
But thank you. I'm glad you enjoyed it. I tend to be very much more hands-on and force you to do things, and webinars are hard for me. I teach, as Brandy indicated, at a university, and this has been the hardest thing for me to do, is to actually switch to the online modality where I'm back to old-fashioned talking head, because we've worked for years and years to try not to be talking heads, and all of a sudden we're back to that again. So.
Well, Mary Lou, thank you so much. This was really great. And thanks to everyone that was able to participate today. Just a reminder, we are going to have a follow-on session next week on operational strategies for profitability, Wednesday at 10 a.m. So go ahead and get registered if you haven't. And then once we have the webinar recording up on our YouTube channel, I will email everyone so that you can go there directly to access it. And thank you, Mary Lou, again.